What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is January 22nd of 2020. Well, folks, I hope you all are having a fantastic day wherever you are, and in today's video, we've got a wide range of topics to discuss. We're going to be taking a look at some Bitcoin TA and data science, as well as diving into some crypto news pieces, and also talking about yet another sign that we are in an absorbently overvalued equity market. But I'm not calling for a recession just yet, and I'll explain why. All right, so we've got lots of interesting things to discuss, but just to share with you guys real quick, this video is sponsored by eToro. Now, for those of you who may not know, eToro is a social trading platform that allows you to interact with other traders, and they recently launched their new cryptocurrency copy trading feature, where you can not only see the performance of different traders over a time period, you can check out their current portfolio, but also a direct chart of their performance as well. So if you're interested, you can not only check out the link down below on eToro, but when you find a trader that you like, simply hit the blue copy trader button and you'll trade alongside them real time at the exact same positions and prices that they trade. So definitely check out the link if you guys are interested. All right, so crypto markets here over the last 24 hours for the most part have been down in the red here. We're seeing a general correction here as Bitcoin's down about 2 to 2.5%. But the thing is, right now, the simple short-term thing, so excuse me guys, the short-term thing that we're looking for here is for this to hold around this level, around 8,300. Now, the reason this is a pretty significant level is really for two reasons. Two areas where this really served as resistance. Right? We could come down to these levels around here at 7,500. I just honestly don't see that happening. What is the real next level that we should test here is both the resistance around this range here. We can see back here and over here, and then also over here as well. This is a general important range here back during the period of September. So it'd be very important to see Bitcoin hold around 8,300. We could correct below it, but until we really see that, I would say that this is an important level that Bitcoin will test. The next one besides that, if anything, would probably be, treating the support here as current support as well. And you can see that it has played a role here in a lot of different areas. Back over here, it served as resistance here for price, almost around 2 times here, and then also supported this range, right? So just looking for those key levels, keeping it simple, doing naked trading on the shorter term time frames from the 4-hour to the daily, and on the weekly, keeping up with our indicators here. Everything's looking fine here. About to get across in the MACD, stochastic RSI ticking up. We haven't even held on the top of the channel here like we did for a multi-month period. So we still, in this case, if we hold on this indicator and we don't dip back down below, I wouldn't fret over short-term price action like this where we're losing a few $100 on Bitcoin. And then also squeeze momentum indicator, looking good. All right. So the TA side looks fine. Price still cusping up here after a multi-week bottom. If we take a look here and look into Bitcoin, they've recently launched a new indicator. Now this one is obviously, excuse me, I gotta fix that. Now, this is obviously not a new indicator or chart to us. We've been using the logarithmic curves to a degree on our channel through the logarithmic chart that I've had. And I know some of you have been asking for that chart. The thing is, I could obviously share charts with you guys on TradingView and stuff. There is a feature where you can kind of like save a layout for specific charts and broadcast it. But this one I think is actually much more useful. And the reason I'll say that is because not only do they get the absolute logarithmic chart here that you should be using in this case, they get pretty much the curves absolutely perfect. But along with that, they have an oscillator here between these bands here that are created by the lines here in excuse me, not the Fibonacci chart, the logarithmic chart. Now, we can see here there's different deviations here that are taking into account the Fibonacci's. And as we go through the higher bands of the Fibonacci's, we get closer and closer towards the upper band. To put it simple, guys, I don't want to make it too complex. Basically, if it gets up to this range or gets close to making contact up here, you can see, generally speaking, that on this chart, when you get into contact with this line that has made contact with the last 3 highs, or was close to making contact with the first one, then you're likely getting overbought. Now, what's nice is this gives us some price projections here. We now have enough price information to where we can kind of get an assumption of where Bitcoin is roughly going to top out at and also where it's roughly going to bottom at under given periods of time. And there's a really cool, this is basically a Medium article from an individual named Harold Christopher Berger, who's really been kind of pursuing finding this kind of perfected logarithmic valuation trend for Bitcoin. And again, I'm not going to be able to dive through the article today, but I'd recommend reading through it, just getting an assumption of it, because it's really cool. I mean, there's general kind of rough estimates on where we can know Bitcoin's price will likely be according to this general kind of trend that we've had over the last 10 years of Bitcoin's history. So for example, he states here that the price will reach $100,000 per Bitcoin no earlier than 2021 and no later than 2028. After 2028, the price will never drop below 100,000, according to the logarithmic chart here. The price will reach 1 million Bitcoin, $1 million per Bitcoin no earlier than 2028 and no later than 2037. After 2037, the price will never drop below $1 million. So again, I want to make it very clear, as he highlights at the top of the article, this is obviously not financial advice, guys. But going off of this logarithmic model, this is taking into account Bitcoin's growth as an asset. It's taking into account the previous cycles. It's taking into account obviously things like the stock to flow in this case, where we're talking about Bitcoin's supply schedule getting cut in half every 4 years. And because of those factors, that's how we can lead to these exorbitant prices, not to mention we're at less than 1% global adoption. And another thing to factor in, outside of the fact that the vast majority of the world doesn't still own Bitcoin, the fact that it still has a few million Bitcoin to be issued, so we're going through those halvings. But along with that, the biggest factor here is inflation, right? If the dollar is excessively depreciated, like we're seeing now, and we'll talk about that as we go through the video, because boy, do we have some interesting points to make in the sense of Fed monetary policy. If that continues to happen, $1 million Bitcoin isn't that crazy. I mean, we've already seen what's happened in equity markets and property markets when, for example, people like you and I, everyday people, we're not easily just picking up properties left and right. We're not buying, tens of thousands of dollars worth of stock per day. No, what's happened is Fed monetary policy has made it very, very easy for assets to inflate. And I can tell you the people picking up those assets are likely not people like you and I. If anything, we own a little bit of crypto. We own maybe some stocks, maybe might own a home, you got a mortgage or something you're paying. So there's a whole stimulus of investment properties, exorbitant equities that have stemmed from Fed monetary policy. And you can see the valuations rising to levels that you and I probably are like, oh my God, how is someone going to afford that, right? So, or who's paying for that, right? Who's paying that price for, Apple stock or for Amazon, right? That's the kind of stuff we tend to ask ourselves. And it's because of Fed monetary policy. And the same will soon be for Bitcoin, because Bitcoin, as time progresses, is becoming an emerging hedge. Right now, it doesn't serve as the lacking of volatility in the sense of store of value, but it's setting higher lows and it's setting higher highs. And this is exactly what we want to see. This is exactly what a store of value should do. And not to mention giving you an opportunity to grow value, right? So it shows us we're an emerging asset, right? That's why Bitcoin is so volatile as an asset. Anyways, I digress. I'm rambling on. Would recommend you check into this, guys. It's free for you to use. I love this oscillator here. Shows us that we were very oversold here, right? It shows us that we were very close to the period when we could pick up the bottom back here in 2019. All right. So very nice chart here. One of the better data science models. Going on here, Bank of England is considering adopting a central bank digital currency, or a cryptocurrency as they like to call it, but it's not a cryptocurrency. So as Libra obviously shocked the world back a couple of, I can't believe it's been about half a year now. It's back during the summer when Libra really finally came out. Yeah, wow, that's pretty crazy. Time flies. But as Libra came out, central banks were obviously on edge, because when they started to see a private company say that they wanted to make their own money, they're like, wait a minute, that's our job. Don't do that, because they already know they can't control cryptocurrencies. And at this point, being censorship resistant, being distributed and decentralized, they're likely not going to stop crypto. But they do not want to be able to they don't want to have to deal with Facebook and other private companies coming together and creating these conjoined digital currencies to compete with their job, not to mention with Facebook and all the companies in the consortium of Libra, or the Libra Association. The issue for them is that they've got scale, to be fair, guys. That's a big plus that they have. They have the platforms with the users. They've got the infrastructure, the licensing to do all things related to financial transactions. They could have easily gotten away with it and grown Libra. But the regulators got in the way. And the central banks are just as worried of that as well. They do not want, much like the regulators, to have any challenging to national currencies. They have every incentive to keep them out of currency building, because it's their job, right? We don't have to make it complex here. There's a lot of mental bias here, obviously, where they like the control of being able to control the nation's supply of currency, but they don't want competition. They don't want to be put out of a job. It's as simple as that. And also, of course, there's immense power, as I talked about, in controlling currency. Anyways, put it simple here, they don't want corporate currencies as much as many of you out there probably don't, competing with cryptocurrencies like Bitcoin or Litecoin or Ethereum. And they're basically in talks now with the Bank of Canada, the Riksbank, I don't know what this is, the European Central Bank, the Swiss National Bank, and the Bank of International Settlements on talking about creating a CB, Central Bank Digital Currency, so CBDC. So this has been something we've talked about for years. It's cool to see it finally coming into light because this was predicted as far back as, I think, 2014 or 2015 by a writer at the Bank of International Settlements. And it tells us, I'll tell you guys, we do it from time to time here on the channel. If you want to know what's going on in the world of banking, read the public documents by the BIS. 98 to 99% of people in finance don't do that. Be a part of that 1% to 2% who read a little bit deeper. The BIS gives out so much information, and they're the central bank of central banks. Like, just to put it simple, they know what's going on in the grand scheme of things. They have some of, I hate to say this, they've got some of the brightest minds in the financial world that know what's going on. And it's sad, I don't think they're using their bright minds to do good things. But the thing is, that's the whole idea. They've got the head. Actually, I will take that back. Not the brightest minds. They've got the most informed in the sense of what's going on. And they have to transmit that information to other commercial banks, to other employees of the financial sector. It's the only way they can generally give a gist of what's going on. And because of that, it's public, and you can go read it. So, anyways, just wanted to make that point. And for the last piece of news here for cryptocurrencies, I guess there's multiple use cases for stablecoins outside of trading. Huh, folks. Anyways, not going to talk about that. Let's go ahead here and talk a little bit about traditional markets here. And I want to talk about probably what is one of the most clear factors to showcase when I say that we are in the longest economic expansion in history, when I say that we are at one of the most exorbitant periods of valuations here. Look no further than the price to sales ratio. Now, you've probably heard about the price to earnings ratio, and a lot of people get caught up in these terms, when we start factoring in key terms like price or sales, and we're talking about the S&P 500, and we're talking about ratios. It might sound a little bit overwhelming for some people. I don't want to say it's going to sound overwhelming for some of you, because some of you might obviously get what that says, but I want to go ahead and just be very clear what the price to sales ratio is before we dive into it. So the price to sales ratio for the S&P 500, that's a very important factor here, is a measurement of the overall valuation of equities in the S&P 500. So the S&P 500 is a basket of practically the top 500 stocks here on the market. It's taking a combination of 500 very large, well-known companies. And we're taking in this ratio the valuation of all those stocks and dividing it by the overall revenue or sales of these companies in the last year. So this ratio changes as valuations change, as the amount of revenue changes per quarter. So we can actually get some pretty big fluctuations here because of those quarterly changes and also the changes in price. So that's how we determine this ratio. The very interesting thing to notice here is that we have just hit an all-time high in one of the most well-known indices in the world, the S&P 500. We have surpassed .com levels of valuations in the S&P 500 with a new high of a ratio of 2.42. Now, I will say a few things here just to be completely fair here, guys. I would like to see the NASDAQ in this case to compare it really to a .com era valuation, but no matter what, the sheer fact that we're up in this range compared to the historical average for the price to sales ratio showcases that we are at absorbent valuations, plain and simple. And you don't have to look very far to know this. I mean, we just look, for example, guys, this is another thing we talked about just a couple of days ago. Near record proportion of IPOs that are coming in at losing money at the launch of their IPO, right? Take a look at this chart here. We're back to the .com bubble peak. It doesn't matter if you're taking a look at the S&P 500's fundamentals, and you can see that we line up with the .com bubble. It doesn't matter if you're taking a look at predominantly tech stock IPOs that are launching out. The signs are everywhere. They're off the charts. Really speaking, like in the real world, you can see it. WeWork was a prime example of this. A company that their only business model was to basically lease properties that they owned and hopefully were aiming to make more of a profit than the cost of purchasing those properties. Losing billions of dollars a quarter not even generating an insane amount of revenue. I mean, they were generating a decent amount, but the valuations that these companies are riding on, that's the divergence there, the revenue and the lack of income to these valuations. It's absolutely insane. And we have to ask ourselves, at the end of the day, what lets this happen? What lets valuations get this high compared to just the underlying revenue, not even their potential to make profit, which all stocks should look forward to? What's causing this divergence, this craziness, this kind of dilution of reality? It's central bank monetary policy. Now, I know I've beaten this like a dead horse, guys. If you watch the channel frequently, you probably know this by now. But I want to make it very, very clear here. As much as it seemed for months, the reason back in 2018 we were confident that a recession was here was because the Federal Reserve and other central banks began to start reducing their balance sheet in 2018. It made sense to have that position, but now it doesn't, because the Fed is re-stimulating markets. And as all the central banks have practically sat on the sidelines here for the last few months to see what the Fed does next, you can very well see here in the most recent update, the yellow line here, the People's Bank of China, China's jumping on the bandwagon. The Fed is stimulating the market, China is stimulating the market, and don't doubt for a second that the ECB or the Bank of Japan are going to step up to the plate too. All of them are going to jump on this bandwagon, and we are going to see a period, very likely over the next few years, of minor hyperinflation, if anything, where we really start to see that if you aren't exposed to assets, if you don't own properties, if you don't own stocks, and if you don't own hedges like gold, silver, or Bitcoin, you are not going to survive this. It's a very sad thing. Or at least if you're not chasing some form of yield on your money. That's the key goal here, is to make sure you're going to be able to hedge against this excess inflation. Because quite frankly, I don't think this is the top here, guys. If they keep doing this, there's still so many tools that the Fed has. They don't have the ability to lower interest rates much lower. They could, and that would stimulate equities even further if they drop it back down to zero and possibly pursue negative rates. But the key thing here that they have is the printing press. They have the ability to print more money. And so long as they do that and possibly get to a point whether they, as we talked about the other day with the repo market operations, if they start doing short-term lending operations to hedge funds to take on excessive margin and basically leverage positions to stimulate buying equities, or if they just themselves start adding equities to their balance sheet in exchange for cash, folks, this stuff can go on for a lot longer. And I was really thinking that the Fed probably wouldn't do this, but it seems central banks are on a course for absolute speculation, and then eventually an even bigger hangover when the punch bowl gets tipped over and the party's over. All right? So, very interesting stuff, guys. We're living in la la land, and quite frankly, I want to be in the best performing asset for this year, for last year, and for the last decade. And luckily, Bitcoin has been that asset. Probably won't get the kind of yield that we got in previous cycles, but I think with this kind of stuff, it starts to become very clear why we can be confident. If we step back here, actually, I wanted to show you guys this on the chart, right? It doesn't show us really the longer term time frame here for the logarithmic growth curves, and I'm hoping looking at Bitcoin does that. But again, I think there's a reason for that. We can't really expand these lines too far without the relevant price data to work with. But generally speaking, if you expand out to 2021, 2022, $100,000 Bitcoin, not only according to the models, not crazy, it's very rational to think that we can have something like that. You don't need much global liquidity for that to happen. You just need some money to flee out of property markets, a little bit of money to flee out of equity markets. It's just a matter of timing and getting awareness around what Bitcoin is. And I think that'll come in due time, as well as other cryptocurrencies like Ethereum and Litecoin and other ones that I'm a big fan of personally. All right, so that's going to be it for the video, everyone. I hope you all are having a fantastic day wherever you are. If you like this video, drop a like. Always appreciate it. But until the next video, I'll see you all in the next one. Stay tuned.